I'm telling you, this is so important because here is everything you need to do as an investor to survive and thrive in a recession. Here on Talking Real Money, I'm Don McDonald along with Tom Cock. And Tom, how do we manage to not end up in the poorhouse in a recession?
Well, I think first you should get the numbers from the fund managers, strategists, and analysts who were polled for a recent CNBC Fed survey.
Should we do that? Why should we do that? Do we really care?
I'm going to give you the probability of an economic downturn because it went up by about a third in March to 36% now. 36%. That's up from 23%. And if to believe Deutsche Bank, they pegged the odds at 50-50.
Wait, hold on a minute.
Yeah.
I did that whole big buildup for a 64% chance that we won't have a recession.
Well, it's a little like the weather. They
you got me going. You are just as bad as CNBC.
I know I am. The president has not ruled out the possibility of recession. The people that make and sell cars in the United States are now going to have to sell those at 125% of what they're selling them at today. A lot of factors here that are playing into what.
Unless it's a pickup truck, which were already overpriced.
Yeah, well, you know how I feel about pickup trucks, and hence sometimes the people that drive them. But yeah, so you're right. Things are looking very dark.
Wait. Okay. Aren't we in? Don't we get in enough trouble just mentioning the word politics or mentioning the word Bitcoin, and then you have to throw in pickup trucks?
I know. Anyway.
What is it? What is it next?
They're usually
Harleys. Do not say anything negative.
They're usually more aggressive drivers. And I don't like that.
And of course, that's based on Tom's very scientific study of one anecdotal crazed man on the 405.
Some guy passed me today going 85 or something. He was in a pickup. So yeah, they're all bad.
Yeah, Teslas never do that.
They never do. Well, not in Seattle. They try to hide them now. So, okay. So if we are, even though it's a 1/3 probability, according to the experts.
Yeah.
Yes. Mm-hmm. What do we do? What do we do?
That's excuse me. I asked that question about 30 minutes ago.
I know.
So what do we do if we think we're heading for one?
I think that was not 30, but might have been 3.
All
so
right,
I do apologize for the delay. So you don't want me to talk about the escalating trade war, right?
Do I?
You don't want me to talk about the.
I like solutions. I don't want to
confidence.
I don't want to rehash problems. We all know about those. Yeah. Excuse me. Oh wait, let me just take a poll of our audience. Okay. Show of hands, how many of you are aware that there is possibly a trade war brewing? Oh, okay. How many of you are aware that consumer confidence is declining? Oh, you read that in the paper. Does Tom need to tell you? No. What should Tom tell you? Oh, did you hear them? How to fix my portfolio. I don't care about the world.
That's better because I thought they were going to tell me how to shut up. So
no, they want your help.
Oh, they want the help. Okay. All right. So what do you do? Bad times are coming. It's dark right around the corner or right over your head or right over wherever it is. It's scary ahead.
Yeah,
so
I know. I'm scared.
What do you do?
What do I do?
What do you do?
What do I do?
I do. Let me think. Make sure I got this right.
That voodoo that you do so well.
Nothing.
What?
0. Thank you.
What kind of answer is that?
Good luck. Bye.
Wait a minute.
Because I've already done it, and you've already done it, and people listening hopefully have already done it.
But wait, I'm reading this article, and it tells you things not to do. The article you're looking at.
Okay, can I tell you first one thing not to do?
Yeah, please tell me what not to do.
Well, because this is from the Wall Street Journal. A woman by the name of Catherine Faddis has been worried about the direction of the economy. In late February and into March, she traded 20% of her stock holdings for short-term treasuries. Quote, I'm not going to put cash under my mattress, but if I hold a 3 or 6 month or a 1 year, that's the next closest thing, said Faddis, who is in her 50s. And here's the important part, works as a portfolio manager for an asset management firm in Boston. She admits it's a fair trade.
I want to know the name of her asset management firm and tell everybody that's a firm you should be avoiding.
Yeah. She admits that the tricky part is deciding when to put the money back into the stock market, because being a market timer is not just one trade, it's 2, right? Maybe. I guess.
Actually,
I've met people that have waited still since 2020.
it's multiples if you're doing it right. But the problem is you got to do it right, not just once, not just twice, but then before the next downturn and before the next rise. And the fact is nobody can do that unless they're cheating somehow.
No, exactly. Okay. But all kidding aside, what could you have done? There you
okay. What should you have done already?
Yeah. Part one is if you're retired, you probably should have some money already in cash so that you can pay the bills, kind of the bucket strategy, if you will. So that it don't matter what the stock market or bond market, for that matter, is going to do.
Now, that is a really powerful piece of advice, because if you have actually planned ahead and have enough emergency money for a year of a market downturn or so, then you don't really have to worry about what your money is going to do in your more aggressive accounts. Not for at least a year.
Right. Your longer term accounts, right? I mean, that's really what you're talking about the longer term. That would be one thing. I guess number two for me would be, we do discuss this a bit on the program, so I apologize if we're repeating ourselves.
No, we repeat ourselves all the time. It's okay.
To do. Understanding risk versus loss. Loss is when you actually sell something and your portfolio's been reduced. Risk is dealing with, acknowledging, understanding the volatility of stocks and also bonds to a much lesser extent, right? The ups and the downs. That's why, for example, we have a free risk quiz you can take to understand yourself emotionally about all this. And that brings me to number two. You got to know yourself before you invest any money. You really do, because people get into all kinds of things and then they find out, whoa, I wasn't prepared to see my money go down by fill in the blank, 15%, 20%, 30%. Could be in Tesla, you're down 50%, right? And so you need to know that, and you got to know your emotional limits and how you're going to deal with them, because you do not want to do what Catherine suggests and has done. Selling. It's outrageous that I wonder, by the way, when I read the piece in the Wall Street Journal, I wonder how many people the reporter had to call before he found that quote. That's the quote that was the money quote, right?
Well, actually, Tom, I got to tell you, I believe that it wouldn't have taken as long as you think, because a very large percentage of that thing, that massive behemoth that is everywhere on the planet that we call Wall Street, and it's just a name because it's not really where they are. That industry thrives on short-termism. They could not exist if they weren't telling you things to do immediately, over and over and over again, because that's how they make you perceive they have value.
Exactly. That they somehow can see the future.
So basically, what you should do about a recession in the future is really what you should be doing from this day on. If you haven't done it yet, whether there will be a recession or not, you should do the exact same thing. Recession or not, you should do the exact same thing. Is that what you're saying?
Exactly. You have a plan, you have an asset allocation, you're going to not be taken in. And by the way, is there a cost of all this? Yeah, there is. Because this isn't just something we came up with to discuss on the podcast. There's actual numbers around what this means. The average stock investor earned 5.5 points less than the S&P 500 in 2023, according to Dalbar. This company that looks at the money that goes in.
I haven't looked at Dalbar in a long time.
I remember the first time the survey came out, I almost fell down.
Just to give you some perspective on that, if the market was at 10% per year returns, just throwing out a number.
Yep.
An average investor, according to Dalbar, would have made by about 4.5%.
Yeah, this is 1 year, Dalbar. You go look at longer periods. Yeah. By the way, the number for 2023, according to Dalbar, was investors made 21, the S&P made 26.
Oh, so it was only 5.5 percentage points lower, not okay, not
in 1 year.
Right, in that
I think in the longer term, it is closer to 3 or 4%, if I remember correctly. But I didn't go in and look at Dalbar. Anybody can go look at that. They publish their results. And there have been, yes, I know, before you write me, some questions about their methodology, but it's a good big picture review because we see the flows going in and out of funds. Guess what people have been taking money out of lately? Oh, stock funds, right? And again, the public, no offense, has tendency to sell after things have gone down, and then has a tendency to buy after they've gone up. Again, the net flow. So what you really don't want to be is something I think we coined 20 years ago when Dalbar started. You don't want to be a Dalbar dummy. That's the person that follows the market and decides, well, the future is so obvious now with the trade wars, with consumer confidence down, all these things. It's obvious that bad times are coming. I'm going to move 20% or more of my money out of stocks into bonds or cash and then get back in. Dalbar can quantitatively show you that has resulted in less money for you.
I went back and looked. Since 1988 through their 2024 survey, their 2025 has not come out yet. According to Dalbar, since 1988, the stock market's average return has been 10% per year, but stock mutual fund investors have earned 4.1% per year.
Say those numbers again.
10% for those who just bought the index and or the market.
Yep.
U.S. market and hung on. 4.1 for the average investor who's buying and selling.
That should tell
and
you
trying to time the market.
Everything you need to know if you pay attention to the aforementioned CNBC, if you read stuff in Money Magazine, if you pay attention to your neighbor or next worker over who tells you this is what's going to happen, you better do something. Those are actual results. As I say, yes, we could argue about the method.
And there are arguments that are legit, but the fact of the matter is, we are pretty confident that no matter what the number is, the science says you don't know anything about the future. That's what the science says, and that's our problem. Is that in our big old brains that are way overconfident, we all believe. Not all of us, but a lot of us. I'm generalizing. We believe that we know something about the future, and apparently we believe that nobody else knows it but us, that the word hasn't gotten out to the rest of the world before it got to you, that you're the first person to ever have this idea out of 7 billion people.
I thought it was 14 billion, but it's 7 billion times 2. I was thinking about the number of shoes. I read once how many shoes there were purchased. 14 billion.
I didn't know we were doing shoot.
No, it's a whole long story, but I read lately. No, I think that's very well put. But yes, all of you, our listeners, have a plan. You all have a asset allocation.
We want them to.
Yeah. You have an asset allocation that accommodates your need for return and your ability to take risk. And number 3, other than this podcast, you know how to tune out the noise.
Yeah. By the way, it's 8.2 billion in the world.
Okay.
The number grew.
That's 16 billion shoes. I was reading the number of shoes that were.
The last time I looked was, I guess, in the 10 years ago when it was 7.4. But we've added another billion people since. It's
been a busy couple of years,
in
Don.
10 years?
You don't get out much, so
Jeez.
I can see how you might not have noticed.
How did that happen?
I think they're all on the last plane flight I was on, too, so most of them.
All right, folks. Apparently, you're having too much sex. Stop it.
Slow it down.
Oh, wait. Too much cheesecake. Sorry. For people with kids in the car.
Say that, yeah. All right, we got time for a couple questions here, so.
Yeah,
okay,
sure.
okay,
yes. It's your time. That's
my time.
Problem. Yes. I can go whenever.
You can stay there for
I don't leave my room.
Mark from Seattle writes, love your show. I've worked on Wall Street for 3 decades making analytic systems for top firms. Your weekly advice is always spot on. I use rebalancing split between treasuries, VOO, which is the Vanguard 500, I believe, correct?
Yep, that's correct.
USMV, which I believe is a
mid-cap value?
No.
I don't know.
It's
I'm looking it up.
Momentum fund, I believe.
Oh!
And VGK, which I do not know, and I did not have time to look up. VGK.
USMV is... No, it's a low volatility fund.
Yeah.
Oh, wow.
Okay.
Getting a little eclectic here, but okay.
And VGK is the Las Vegas Knights. No, that's not right. It's
the Vanguard FTSE Europe ETF.
Okay, so
all right. Sounds like you're making some bets.
Yeah, we don't love that asset allocation, but that's not the question. So
no,
you're going to get our feedback on that anyway, Mark. Am I wrong to hate bond funds? They seem to have both low return and still volatility. So I use treasury ladders and hold the maturity. The downside of ladders is they're a pain to maintain. I use fixed income to reduce volatility and risk while accepting lower returns, but bond funds just seem to have the lower return part. I definitely avoid the high return, high risk bond funds you warn about. Bond funds, you've discussed this. You're a laddering guy.
I love laddering because I can do the work.
Yeah,
okay.
Most people bond fund is fine. It's good.
Exactly. And here's the reason. And this is what you have to understand about bond funds. There is a certain amount of momentum built into bond funds and a certain amount of flexibility. So you kind of get a little of the worst of both worlds and the best of both worlds. What that means is that in an environment of steadily rising rates, your short-term securities, now again, this does not compare well with a ladder. Ladders are great, but compared with other ways of doing this, you're going to either get caught up in short-termism where you're chasing rates. They're going to be all over the place. In a period of rising rates, your rate's going to rise on your short-term things, but in a period of falling rates, your rate's going to fall on short-term things. With a bond fund, you still chase rates up a little bit. You get a higher yield as the old bonds mature and new bonds come in. But on the valuation side, you get some protection from those longer-term securities paying those higher rates over a longer period of time. So,
all right, will you look something up while we're discussing this?
I look
the 15-year return of BND.
Oh, absolutely, I have that. I have that at my fingertips.
Yeah. So remember, diversification.
Okay, you're not going to like the number.
I probably won't because bonds haven't paid particularly well for about 15 years. Diversification, low cost, and the work gets done. All right, what's the 15 on BND?
2 1/3.
Yeah,
2 1/3%.
It is low. It was, and we had the ugly market in 2022,
which was only a 13% loss, though.
Right.
Which again sounds big, but when you put it in perspective, I mean that year. The S&P 500, it lost. Gosh, I'll get the exact number. I'd rather have the exact
S&P
number.
In 2022.
No, in 2013. In 2022, lost 18%.
Yeah, I was going to say 20. So yeah.
So you're getting a little bit higher degree of safety. Remember that 15-year period also includes a long period of time when rates were low,
almost zero.
Almost
I was going to
zero.
mention that. So yeah, okay, but I would still use bond funds. I think most of us...
For most people, it's a lot easier.
It does. Okay, another question from Jeff.
And they're basically laddering for you.
Exactly.
Actually, they're laddering for you.
Guess what? They're buying new securities that are paying a little more today than they were, well, can't we say that the last year? So I don't know. Rates have been kind of awkward.
They buy
Jeff,
whatever the market rate is.
Exactly. Writes us from Emerson, Georgia. Wanted to get your thoughts on parking money in a vehicle like DTAXX versus putting money into a high-yield savings account. Want to minimize earning but keep it liquid? Thanks. And he also writes, don't forget the dryer sheet. Thank you, Jeff. That's very
reference to the laundry room.
In the laundry room.
The DTAXX, I'm not sure why. It's a Dreyfus fund.
Dreyfus, yeah.
I don't know why you'd be looking at a Dreyfus fund.
Not it does have a needs.
It has an attractive yield.
Yep, it
does.
It's over
4.76, which is for a money market fund. That's on the very high end.
It is. Makes me wonder
spectrum.
How they're doing that.
Well, again, it's a high quality portfolio, but it's not the highest quality. It's, there's some cash-based obligations that are federally backed. I mean, it's good enough. It's good. It's a good portfolio. One of my concerns is I don't know how they overcome their expense ratio and pay that.
How much?
30 basis points.
Yeah.
which for a money market fund is on the high side. I'm trying to figure out where they got a lot of.
It's treasuries, though,
cash.
Right?
Yeah, but there's something.
DTAXX.
They've got treasuries, but they do something else because they have.
That's the part that always makes me worried about cash.
They're stretching their maturities.
There you go.
Okay, I see it now. Their effective maturity is 2 years.
That's not very cash-like. So, in today's world, it's worked because that's where rates are. But I would probably still use a high-yield savings account, Jeff, if I had my druthers.
Yeah, I just want to look at the Vanguard Treasury money market, which, by the way, has an expense ratio of 7 basis points.
So 1 quarter.
No, same maturity. Same maturity.
Okay.
Huh. I am
trying to figure out why the yield's
I'd have to actually pull out a full quarterly report because Morningstar just doesn't give me enough information.
They only give a very perfunctory look.
But I'm just trying to figure out how they. Oh, no, they're under Vanguard. Okay. Oh, sorry. Vanguard's 4.95. Go with the Vanguard Treasury money market.
Vanguard's paying 4.9, and
it's paying more than the Dreyfus.
DTAXX is paying 4.7. Okay.
And that is reflective of the expense ratio.
Yeah. Turns out.
It's about 25 basis points better.
Yep.
And that's the expense ratio.
There you go.
What a great example of why an expense ratio makes a difference.
Yeah. Especially in this circumstance. So, yeah, that's good. Thank you, Jeff. Thank you, Mark, for your questions. We love your questions. We take more of them. We need questions every week because we use them on the podcast. Sometimes we use them on the radio show. We will answer your questions. We really do.
Yeah,
I think answer them in the order they're received.
I've got on the Friday show. I've still got a little bit of a backlog, but I'm within a couple of weeks of being totally caught up.
Yeah.
We also, though, this is the part that a lot of you podcast listeners are not aware of, and that's the fact that we have a live call-in 2-hour session where we talk to you, like back and forth.
That's assuming the fiber gets hooked up at my house.
For 2 hours. Yeah, it didn't work so well last weekend.
Yeah.
I had to do a lot of editing on the show. But you can call us on Saturdays at 855-935-8255. That spells talk. 855-935-TALK. Just call between 3 p.m. and 5 p.m. Eastern time, and we can almost always get you in as long as you don't wait until 4:45 Eastern time to call.
Sometimes people do that. And by the way, you want to get personal? You really want to get personal? Yeah, we can do that
I really
too.
don't.
Okay,
I don't.
we could do that.
You're talking about business-wise.
Yeah.
I thought you meant you and me.
No,
and I just don't want to get that personal.
We've avoided it for 30 plus years. Why would we change that now?
Get away from me.
So you're 3,000 miles away.
Well, you are away then. Look how that worked out.
Small room. Padded, yes. But if you want a little personal help, you simply go to talkingrealmoney.com and click on Meet an Advisor. You want to talk to yours truly, just write, I want to chat with Tom. I've done that all week.
You can do that. And then there's a Contact Us button where you can also send in questions at talkingrealmoney.com. Go check it out, talkingrealmoney.com, the place where all of this comes together. But the real good stuff happens on this podcast and our radio show when we, instead of just telling you stuff, are actually talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?